If you own a home and you are retired, there is an important update you need to hear today because many older Americans are quietly losing thousands of dollars simply because they were never clearly told about one IRS home tax rule that could change how much money stays in their pocket each year. This is a direct update, and it matters now more than ever because housing costs remain high, property taxes continue to rise in many states, and retirees are depending heavily on Social Security, pensions, and savings to maintain stability. Yet across the country, tax professionals continue to report the same troubling pattern. Retirees making a costly mistake on their federal taxes connected to their primary residence. It is not always because they misunderstood the law. Often it is because the rule sounds complicated, the language feels technical, and no one ever explained it in plain English. Today, that changes. For many retirees, the home represents far more than a building. It represents security, memories, independence, and in many cases, the largest financial asset they will ever own. After decades of mortgage payments, maintenance costs, insurance premiums, and property taxes, finally owning a home outright can feel like reaching the finish line. But what surprises many seniors is that the financial relationship with that home does not end once the mortgage is paid off. In fact, from a tax perspective, some of the most important decisions begin during retirement. The IRS home tax rule that so many retirees miss often becomes visible only when it is too late to fix without financial consequences. The mistake can show up when filing annual taxes, when selling the home, when transferring ownership, when claiming deductions, or even when adjusting income after retirement. The result is often higher taxable income, reduced eligibility for certain benefits, unexpected tax bills, or penalties that could have been avoided. To understand why this is happening, it helps to look at the financial reality many retirees are facing today. Social Security benefits provide essential income, but for most households, they replace only a portion of pre-retirement earnings. Pensions, once common, are now far less widespread. Savings must stretch further due to longer life expectancy, healthcare expenses, and inflation. Every dollar matters more in retirement than at almost any other stage of life. That is exactly why overlooking a home-related tax rule can have such a powerful ripple effect. Losing even $2,000 or $3,000 unnecessarily is not just an accounting issue. For a retiree, that amount could represent months of groceries, prescription medications, utility bills, or insurance coverage. One of the most misunderstood realities about retirement is that taxes do not disappear once paychecks stop. Many seniors are surprised to learn that Social Security benefits may become partially taxable depending on total income. Withdrawals from traditional retirement accounts are usually taxable. Investment income can raise overall tax exposure. When a home enters that equation, the situation can become even more complex. A growing number of retirees are discovering that the IRS pays close attention to how homeowners report costs, gains, improvements, and residency status. The rule itself is not designed to punish retirees. In fact, many home tax provisions were created to protect homeowners. The problem is that protection only works when the rule is understood and applied correctly. One major area where costly mistakes occur involves tracking the true value of the home over time. When a person buys a house, the purchase price becomes the starting point for tax calculations. However, what many retirees fail to record properly are the improvements made throughout the years. Renovated kitchens, roof replacements, accessibility upgrades, energy-efficient windows, and structural additions can all influence the financial outcome when the home is eventually sold. Without accurate records, retirees sometimes report a higher profit than actually exists. That difference can translate into paying more tax than necessary. It is not uncommon for homeowners to forget improvements completed decades earlier simply because paperwork was lost or never considered important at the time. Another situation arises when retirees decide to downsize. After children move out and maintenance becomes harder, selling the longtime family home can feel like a practical step towards simplifying life. Yet the financial side of that sale can carry consequences if the IRS rules are misunderstood. Many retirees have heard that there is a generous tax exclusion available when selling a primary residence. What they sometimes do not realize is that this benefit depends on meeting specific residency requirements. If those requirements are not satisfied, the expected tax break may shrink or disappear entirely. Life events can unintentionally complicate this timeline. Some seniors move temporarily to live closer to family, assist with grandchildren, or recover from medical procedures. Others spend extended periods in another state. Still others relocate to a care facility while keeping the home. These transitions, while often necessary, can affect how the IRS views residency. The result can be shocking. A retiree expecting to keep a large portion of sale proceeds might instead face a significant tax obligation simply because the technical definition of primary residence was no longer met. Beyond residency, another area of confusion involves home office use during late career years. Some retirees continued part-time consulting or remote work before fully stepping away from the workforce. If a portion of the home was claimed for business use, that decision may later influence tax treatment when the property is sold. It is not unusual for retirees to assume that once they stop working, previous tax choices no longer matter. Unfortunately, certain deductions can trigger what is known as depreciation recapture, which may increase taxable income upon sale. For someone living on a fixed income, an unexpected tax bill arriving after the sale of a home can feel deeply unsettling. What should have been a moment of financial freedom instead becomes a source of stress. There is also a quieter mistake that affects retirees who never plan to sell at all. Some homeowners assume that because they intend to age in place, tax planning is unnecessary. Yet property-related decisions can still influence annual tax filings, benefit eligibility, and even estate outcomes for heirs. As retirement progresses, many seniors look for ways to manage rising expenses. Property taxes alone have climbed in numerous regions. Some states offer relief programs, but not everyone enrolls. Others qualify for deductions but fail to claim them simply because they were unaware the option existed. The larger pattern is not one of negligence, it is one of information gaps. Tax law evolves, forms change, thresholds adjust, and what was true 10 years ago may no longer apply today. Adding to the challenge is the emotional dimension of homeownership. A house is rarely viewed purely as a financial instrument. It is deeply personal. That emotional connection sometimes delays practical conversations about taxes, records, and long-term planning. Yet retirement is precisely the stage when clarity matters most. Financial surprises are harder to absorb without the cushion of employment income. Stimulus programs over the past several years highlighted how interconnected taxes and benefits can be. Eligibility often depended on adjusted gross income, which in turn could be influenced by housing decisions, retirement withdrawals, or capital gains. Some retirees unintentionally push themselves into higher income ranges during the sale of a property, affecting not only taxes but also healthcare premiums and other cost structures. Understanding this connection is not about creating worry, it is about creating awareness. There is encouraging news within this conversation. Many costly mistakes are preventable. With the right knowledge, retirees can position themselves to protect more of their money. One of the strongest financial habits any homeowner can develop is documentation. Keeping records of major home improvements, purchase details, refinancing costs, and structural changes creates a financial timeline that may later reduce taxable gain. Even improvements made for safety or accessibility, such as wheelchair ramps or bathroom modifications, may carry financial relevance. What once felt like a simple home adjustment could eventually support a more favorable tax calculation. Another overlooked factor involves timing. Retirement often brings flexibility, but major financial moves still benefit from careful sequencing. Selling a home in the same year as large retirement withdrawals, for example, can amplify taxable income. Spreading financial events across different years may sometimes create a more balanced outcome. This level of planning is not reserved for wealthy households. It is increasingly important for middle-income retirees whose margins are tighter. The conversation also connects directly to the broader retirement landscape in the United States. Policymakers continue to debate ways to strengthen Social Security. Cost of living adjustments attempt to help benefits keep pace with inflation. Pension systems adapt to economic shifts. Yet regardless of national policy changes, individual tax decisions remain one of the most controllable factors in retirement stability. That is why this IRS home tax rule deserves attention today, not because it is new, but because it is frequently misunderstood. Financial professionals often describe retirement as a transition from accumulation to preservation. During working years, the focus is on building assets. In retirement, the priority becomes protecting them. Every unnecessary tax payment works against that goal. There is also peace of mind that comes from knowing the rules. Confidence replaces uncertainty. Decisions feel deliberate rather than reactive. For many retirees, the desire is simple: remain independent, avoid becoming a financial burden on family, and enjoy the years ahead with dignity. Protecting hard-earned home equity plays a powerful role in that vision. As this discussion continues, it becomes clear that the most expensive mistakes are rarely dramatic. They are usually quiet oversights that compound over time. The good news is that awareness can shift the outcome. Small adjustments today may prevent large losses tomorrow. As we come to the end of this update, the most important thing to remember is that retirement is not just about how much money you have saved, but about how well you protect what you have already earned. Your home is more than a place filled with memories. It is one of the strongest financial pillars supporting your future. Missing a single IRS home tax rule may not seem like a big deal at first, but as you have learned today, even a small misunderstanding can quietly turn into a costly mistake that affects your income, your savings, and your long-term security. The encouraging truth is that awareness changes everything. When you understand how these tax rules work, you place yourself in a stronger position to make careful, confident decisions. Instead of reacting to unexpected tax bills, you can plan ahead. Instead of losing thousands of dollars unnecessarily, you can preserve that money for the things that truly matter: your healthcare, your daily comfort, your independence, and the peace of mind that comes from knowing you are financially prepared. Retirement should be a time of stability, not financial surprises. Every smart decision you make today helps create a safer tomorrow. Take these insights seriously, keep your records organized, stay informed about changes that may affect homeowners, and approach every major financial step with patience and clarity. The goal is not just to avoid mistakes, but to ensure that the life you spent decades building continues to support you in the years ahead. Thank you for spending this time focusing on your financial well-being. Stay attentive, stay prepared, and most importantly, continue protecting the future you worked so hard to achieve.